When it comes to investing, we usually focus just on the returns and not the risk. You've heard the phrase, no pain, no gain. That really sums up the risk and reward part of your investments. Don't let anyone tell you otherwise. Every investment involves some degree of risk. And some part of this risk can be mitigated with proper asset allocation. Asset allocation is nothing but balancing out risk and reward. It is using careful balance with diversification that helps you earn more for your buck that you invest. So have a fund that has more of diversification, more of asset allocation, and then you can balance out risk and reward carefully. The best example to explain diversification is, have you ever noticed street vendors selling seemingly unrelated products? For example, umbrellas and sunglasses. Initially that may seem odd. When would a person buy both the things at the same time? Probably never, and that's the key. Street vendors know that selling unrelated products will help them to sell at any point of time. Like sunglasses will sell on a sunny day, whereas umbrellas will sell on a rainy day. So what here the street vendor is doing is diversifying his product line so that he does make money on any given day. So that's more of diversification. So you need to choose investments and diversify your investments into different asset classes, and that's going to help you balance out the risk. That makes sense to you. You've got a great start to understanding asset allocation and diversification. By including asset categories that move opposite to each other or move under different market conditions differently, you could achieve pure diversification and have an asset allocation that balances out risk and reward carefully. So there are various issues when it comes to investing in terms of disciplined investing, finding the right mix of balance and assets within your portfolio, diversifying, rebalancing at periodical intervals is very necessary to achieve a proper balance between risk and reward and achieve long-term wealth. So investors do agree with these principles but often don't follow it just because it's tedious, it's time consuming, and lack of proper knowledge and time leads them to deviate away from these core principles of investments. So here we bring to you the Quantum Multi-Asset Fund. This is a one-stop solution for investors' basic need of investment. Here what happens is we focus on reducing the risk involved in investing and try to generate moderate, sustainable returns over the long term. So diversifying is the key aim, where we diversify your investments into different asset classes, namely equity, debt, and gold. So what happens with these diversification, if you see equity and gold move opposite to each other, and thereby it gives you diversifying portfolio across asset classes helps to reduce risk and aids in stability of returns. What we do in this fund is to try to diversify your assets into three baskets, namely equity, debt, and gold. What happens here is we dynamically manage the portfolio depending on the economic scenario and the valuations that prevail vis-a-vis one asset class vis-a-vis the other asset class. So relative valuations is a key that goes into determining the optimal allocations for this fund. And one needs to realize that ideal asset allocation is not static. As markets move, you need to change your composition of the portfolio depending on the valuations of each of the asset class. At a certain point of time, one asset class would look more attractive as compared to the other asset class, or one asset class may look more risky as compared to the other asset class, and at that point of time it makes sense to divert your asset towards optimal risk reward ratios across these asset classes. One more thing is you need to rebalance your portfolio at regular intervals, because what happens is when markets move, you tend to overweight the asset class that has appreciated more than the asset class which has not appreciated at that much or has lost value. So you need to rebalance your portfolio at periodical intervals so that you do not emphasize more on any one of the asset classes. So rebalancing is more important when it comes to putting assets and diversifying across asset classes. So gain the asset allocation advantage by investing in one single scheme. No need to monitor various markets or worrying about the different asset classes or finding the right mix and balance between these asset classes. You need not worry about rebalancing or moving into one or the other asset depending on the economic cycle. It's all being taken care in just in one fund. So make quantum multi-asset fund a core part of your portfolio.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.